Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, June 24th, 4:52 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with The Big Show, the Friday edition of the Revere Market Insight video where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update, or in this case, rebuild the world famous 21 over 21 leaders list. Let's get right into it. So yesterday, it appeared we had a day 4 follow through day, but after the final volume numbers came in, we fell a bit short in comparison to the prior day, but there was no question about it today, although possibly a bit of an asterisk on it because there was a huge Russell rebalancing today where a massive volume came in at the end of the day. Prior to that, volume was tracking just slightly below average. So we follow the rules. We'll call today a day 5 follow through day. I'm not getting rid of correction though. We want to see at least 2 closes above the 21 on these big cap averages. The mid and small cap haven't gotten back above it yet. So before we take the correction label off, this is just a bear market rally. Check over here at the trend gauge. You can see we're still showing bearish on leaders, although we do have 21 for the list, and we'll go over those later. The sub arrow pointing toward neutral. We see continued improvement. We'll upgrade these. As I mentioned, short term, the big cap indexes with the first close above the 21. We want to see a second close. We've failed after one close several times during this sell-off, so still bearish, but again, the sub arrow pointing toward neutral. Medium term, the next hurdle to tackle will be the 50-day moving average, so we're still showing bearish there, and same thing with long term versus the 200-day moving average. So making progress off the lows. Whether or not it's a true rally will remain to be seen. We'll have to see what kind of action we get next week. So what happened today? As I mentioned, strong follow-through day rally, regaining the 21 EMA for the big cap indexes. Some nice green close numbers here. We gapped up at the open about 1% and took off to the upside, gapped over some key resistance being the 3,800 area at the open, and didn't look back. We had a quick run up, consolidated for a while, and then another run up into the close. So G6 up 3.2%, good participation for the second day in a row, and some beaten down small cap and mid cap stocks there coming off their lows, forming rounded bottoms, and a lot of them didn't make lows last week when the indexes did, so that's a good sign. S&P up 3.1%, NASDAQ 100 up 3.4%, Dow up 2.7%, mid caps up 3.6%, Russell up 3.2%. Global diversified 60/40 stock and bond index up 1.73%. GROTECTION dipping more toes in the water, up 0.6% on the day. You look at these numbers and you say, well, you're only up 0.6% on the day. Well, let's take a look at this little chart here, and let's go back to 2 weeks ago from today, where CPI came in bad pre-market. The rally was officially dead. We closed the day at 3,900. Where did we close the day today? 3,912. That's a massive gain of 0.28%. And when I say massive, that's with derision. So look what we did. Let's compare that to where we are in GROTECTION. We closed 610, actually went out net short that day, and didn't lose another penny since then. We've just chipped away little by little, not massive returns, but we don't need to make massive returns, because when we're in a bear market and under the 200-day moving average, we want to minimize our risks and wait for the wind to shift from in our face to at our back. So that since that close, we're up 1.25%. So beating the S&P during that period, but look at what we missed, and this is the key. This is why we do what we do. Under the 21, when we broke back below with the CPI, that killed the rally. And then we continued down 4%, a little bit of a rally, down 3%, huge sell-off, down 6%. Next day, still down 5.8. Now we start chipping away on 621, a little bit more at the top, and then a little bit closer to the top, and then a nice day on 623, and now finally back positive. So we missed this big sell-off during this sell-off, we reached 23% down intraday. Let's take a look at the drawdown numbers here. You started the year with $1 million portfolio, all in the S&P 500. At your drawdown low, you were all the way down to $769,000. Currently at $821,000. GROTECTION, protecting your capital, our low is $916,700. Now at 928, 120. Look at how the difference, still over $100,000 higher on $1 million portfolio. This is how the power of compounding kicks into your favor when you don't have to have these big drawdowns. You get to sleep at night, you get to compound from a higher level, and that's why we follow the rules that we follow. They don't always work, but when they work, we'll be wrong small, and then we'll pivot and get back in or get out, depending on what we need to. If this rally fails Monday, we've got a whole if then else scenario for what we'll be doing then, and just like we do going into every day in the market. So it's a little explanation of where the market went and what we've done over the last 2 weeks, chipping away, adding a little bit to cutting into the year-to-date losses. So currently down 7.2% year-to-date. The S&P still down almost 18%. So we're pretty happy with the results that we've gotten. We've got a lot of good feedback from clients. As I said, it's the sleep at night factor is what we add. So let's get into the charts, but first let's get into a look at the team here at Revere. Contact us if you're interested in a trend following approach where you participate in market uptrends, back off a little bit during market pullbacks, get the heck out of the way during bear markets. You sleep at night, you compound from a higher capital position, and participate only in leading stocks when the market's in your favor. So reach out to any of us. We've had a lot of great feedback from the interview I did with Richard Moglen. If you're not aware of that, reach out to us. It's on YouTube if you go and Google Revere Asset or Google Richard Moglen and scroll down and see that. I talked about our entire process from end to end, and it really focused on capital preservation, which has certainly served us well this year. Email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's take a look at this follow-through day here. So here's the S&P 500. You can see really just we've traded in a range over the last 2 weeks. On the high side, 38.30. On the low side, 36.34. This was the big breakdown, 2-day breakdown last Thursday and Friday. Sorry, the 16th and the 17th. Yeah, last Thursday and Friday. This was the day that really, the 10th, the day that really killed the rally after the Fed, when we broke down, and then this big gap down on 6/13. Back above that now, that's the good news. What's the bad news? Well, big area of resistance here at 3,900, but we did manage to close above it on a squeeze into the close. We're up to 39.12. And our first close above the 21. Let's see what happens. Here we touched the 21 and failed. Back here we had one close above the 21 and then two reversals after that. Here we got above the 21, just went sideways for 2 weeks and ultimately failed. But we're going to, we got rules, like I said, if then else scenario going into every day. One close above is excellent news. If we get another step above today's close, we'll add more positions. We've got a nice list of stocks with some reasonable risk reward entry points. And if we break down, we're going to lock in our profits and we're going to step back to the short side as long as we're under this declining 21-day moving average. That's the green line, although it did flatten out today with this close back above it. So that's a good sign. Overhead, we've got the declining 50-day moving average. That's another 3.8% above us, and the 200-day moving average, a big 11.2%. Above us. That's the NASDAQ, that's the S&P 500. Here's the NASDAQ 100. Intraday, very interesting. So we got into the 21-day moving average around, it varied from 290.70 to 290.96 where it closed today. But every time today, once we got back above it, we started pulling back here, okay? and we were like, this could fail, or we had trades loaded up to go short if the Qs failed, or to go long if it tested it and reclaimed it. So here was one test of the 21. We pulled back, we held it, we got back above it, we tried to pull back again, we held it, we made a slightly higher high, we pulled back again, and we got back above it. And this is where we took a shot at the NASDAQ 100. We bought in, then with a little bit more strength, we added a second position to it. So we've got 10% in the QQQ right now. Both buys are profitable, just like both buys in SPLG that we took early in the week when we came off the lows are profitable. So simple case of breaking through resistance at that area, coming back, testing it multiple times, and it held. That was the information that we needed to put our money into the NASDAQ 100. And as long as we stay above this 21, we'll continue to ride it higher. If we fail here on Monday, or if we get up to the 50 and we fail, then we'll take that money off the table. But for now, follow through day, decent action in some stocks. Close above the 21. We want to see a second close above there, and we'll see what Monday brings us. So that's the NASDAQ 100. Dow Jones Industrial Average, also first close above the 21. This looks a whole lot like the S&P 500. Mid caps didn't quite get there yet today. Not quite to their gap down. Look at the 610 where we are on the gap down here, and how we reclaimed it on the big cap indexes, but haven't on the mid cap indexes. See how we're above there, 3901 on 610, 3912 today. Above it on the S&P 500, above it on the NASDAQ 100, right above it on the Dow Jones Industrial Average, but not above it on mid caps. Let's take a look at small caps. Not above it either. Right into the declining 21 is where we stopped today on the small caps. So a little bit of work to do on mid caps and small caps. But where we put our money in was into the SPLG, which is an S&P 500 fund. And the reason why we don't do SPY is because SPY waits 5 weeks to pay out their quarterly dividend, which is just ridiculous. SPLG, VOO, and IVV, the other three big S&P 500 ETFs, pay it out within 5 to 6 days. So people ask why we don't like SPY. That's the reason. Plus the SPY is 0.09% in expense ratio, and the other three are 0.03%. So plenty of reasons not to like SPY, even though SPY is the most liquid and most well known. So that's what we have to deal with. That's what we're looking at in the indexes. So what do we see for next week? This, as I said, this 3,900 is a big area here. It stopped here. We battled. We undercut and reclaimed it here on 512, closed right at it on 519. Same thing with a shakeout on 520. Worked our way above it on 523, undercut and reclaimed it on 524. So big area here. It's going to be very interesting to see what we see next week, if we continue to power higher or if we see a reversal below this level and a failure at the 21. So that's the key that we're looking for next week. Now let's get to some individual stocks. Let me shrink this back down. And let's take a look at our fresh-faced 21 over 21 leaders list. Here's the entire list. We've got 11 sectors, 18 different industry groups, so we've got some diversification there. And let me go through these in order of 3-month relative strength. Let's sort this by 3-month relative strength and get to it. So first stock, I put a Chinese stock in there. This is where money's flowing. Important to remember that the Chinese central bank is easing financial conditions now, while the rest of the central banks in the world are tightening. Money goes to where it's treated most kindly. And right now, despite the fact that it's a communist government and they've got their boot on your throat or on the throat of the Chinese people, this is where the money is flowing, and PDD is a pretty good looking stock there. Zoom, we bought this in two buys on this yesterday, 2%, another 2%. We got a 4% position in this, showing a decent profit, up another 4.2% today. I've been talking about this for weeks since it acted really nicely on its earnings gap up, hardly pulled back when the market was doing the harsh pullback. Couple of big moves up, pull back, nice move higher, continued to follow through and make new highs each of the last 3 days. So, and then finally closing at new highs today. So it's the only stock we own besides the index ETFs, GLD, and our short-term inflation protected bond fund. You know what? I didn't go through the tail of the tape. I knew I felt something was missing, but let's go through this real quick. And you're aware of what we saw. We already went through the S&P 500, but I'll bring this back very quickly so we can match these two up. We're kind of straddling the bull and bear case now. One of these will win. We've got the day through follow through day. First close above the 21. Again, we want to see the second. Some news today, the 10 a.m. Michigan consumer sentiment fell to a new record low. Didn't seem to impact the indexes, though, as we had a little pop at 10 o'clock on a breakout. Coming into this morning, we were wanting to see this 3,800 resistance level. That flipped to support when we gapped back above it. Low of the day was 38.21 on the pullback. And then 3,900 broke above that into the close. So very nice. Here's the intraday action. Gapped above the 80 MA, closed above the 21 on the S&P. All 11 sectors up: stocks, software, base metals, XME, banks. KWeb is China internet that trades in the U.S. The only thing weak today was bonds and GLD. Added to QQQ, so our Revere volatility adjusted beta is 0.34, so about a third of the overall S&P 500, about half of a 60-40 portfolio. Bottom line, strong day 5 follow-through day, breaks above the 2-week range and the 21-day exponential moving average. So you can see what we've reclaimed here, and these various what were resistance levels now become support on any pullback. Pretty decent week for the indexes. Now back to the 21 over 21. I mentioned Zoom. Let's go back to Chewy, former leader, carving out a bottom again. A lot of these stocks, as we said, did not make lower lows the way the indexes did last week. Chewy also with insider buying, turning its short-term moving averages up. Still a nice way to go before it would reach the the declining 50-day moving average, but really good action in Chewy. GTLB, Computer Tech Services. A lot of these patterns are going to be similar. There's some overhead resistance here, but this is where the money has been flowing over the last couple of weeks, and we'd be remiss to not list them just because we've got some resistance on the left side of the chart. Enphase, solar's looking pretty good. Double bottom breakout, failed, trying to get back above it here. Good relative strength. Always note the relative strength line here on our MarketSmith charts. Vertex breakout, and the breakout is holding. Look at the volume 3 of the last 5 days here. Just really exhibiting some strength. I didn't buy it because it was the 5th day up off the low, but not stopping at this point, money flowing into the medical sector. Shockwave, 4 days straight up into 200, but reclaiming all the moving averages. Path, this is another setup similar to Zoom, where it stopped going down and showing relative strength since it reported recent earnings. FedEx had a nice gap up today. FedEx has the end going for it. They got a new CEO, some new board members, increased their dividend, and now reported earnings with a gap up. We got our eye close on this one. As you can note, there's some resistance over here at this 236 to 250 level, which is right where we are. We want to hold the low of the gap up day, which got above the gap up day when they increased their dividend. So some good stuff here from FedEx. Also a PE of 11. Monster popped this week on speculation that they might get that was Celsius that. The speculation was they might get bought by Pepsi, but Monster, there's always talks that Coke might buy them. They are the distributor for them, but regardless, the price action is there. So is the relative strength. So is the volume. AT&T, after this harsh sell-off, it has recovered. Very typical pattern with a lot of defensive names. They were just capitulation selling last week going into them, and they are doing V-shaped recoveries this week. Let's see if those V-shaped recoveries hold. Lilly had a really good week, gapping up today to all-time highs. Dollar General continues to act well. Merck, it was another one that sold off hard and recovered most of it over the last 4 days. T-Mobile continues to look well, another one that sold off hard, recovered it this week. AMT, American Tower, very steady income stream. They rent cell towers, classified as a REIT because of how they pay out dividends. Relative strength at a new high, forming a cup and handle. CNC, Hunter brought this one to my attention. They raised guidance this week, forming a nice double bottom. UNH is usually the leader in this space, but CNC showing the superior relative strength. Note the relative strength new line touched a new high here, while price still hasn't. Northrop Grumman, harsh pullback over the last couple of weeks, hasn't really regained much of it, but it's above the moving averages, and it's representing the aerospace tech sector in this list. Ulta, kind of shaky since it reported its earnings, but held the 200-day moving average and bounced up along with the market. BJ's, big volume today. That's Russell rebalancing, but the relative strength was at a new line before that, also forming a double bottom and back above its moving averages. And PWR, Quanta Services, forming kind of an ugly cup and handle. Reported earnings back here. Harsh sell-off here, but the volume wasn't too bad, reclaiming it today, and it gives us some diversification in building and heavy construction. Not a bad-looking chart at all, and that's our 21 over 21 list going into next week. As always, love to hear feedback from you. You can email me, don@revereasset.com, phone 855-REAL-WELL. So remember, it's not how much you make, it's how much you keep in the market. That's why we do what we do at Revere, protecting your capital during harsh sell-offs and then participating when the all clear is given, or at least we've got a yellow light right now and not a big flashing red light. So putting some money back to work, if it continues to work, we'll chip away at this deficit, but we're in a great position with a 10 percentage point basis lead, more than that, versus the S&P 500 this year. So we're compounding capital from a much higher base than if you sold all the way down 23%. That's the way we do things here. And if you have any questions, feel free to reach out to us. So wrapping up the week ending 6/24, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great weekend.